What is going on, guys? Mark Berta here. In this video, I'm going to talk about dividend investing. It is something that I used to passionately embrace. And when you buy and hold stocks that give dividend, you reinvest. And each year, the company raises the dividend. So you make even more money each year just by holding the same stock. So dividend investing is certainly, it has a very attractive exterior. It has a very attractive model. But there is a way to make a lot more money than through dividend investing. Once I came across it, I just decided to not be as serious into dividend investing. The problem with dividends is that, I mean, getting the payments always good, but the companies that are known for dividends, like your AT&T, that is the stock that gets brought up the most by, this is an income investor group. They just go for stocks that have really high yields and not much growth. The issue is that you're not going to see that much appreciation in the stock price, which, sure, you're getting a high dividend, but you're really capping your return. And then you have a company like Apple, which, yes, it's a great company, but who really buys it for the dividend? The dividend's just a cherry on the top. I mean, no one's really out there bragging about how Apple pays like the massive, like less than 1% dividend because of how much the stock has gone up lately. But the strategy that's worked really well for me is options and not buying the options. Buying the options is just straight up gambling, especially if you are one of these people who buys the option on the same day it's going to expire, hoping you make a ton of money and hoping it doesn't expire worthless. What I'm talking about is selling covered calls on stocks you already have and selling cash secured puts on stocks you want to buy, but you're not ready to buy at the current price. So the way that these work is, for a covered call, you need 100 shares in your portfolio already. In a cash secured put, you need 100 shares. You need enough money to buy 100 shares at your set price. So we're going to take a company like Apple, because we just talked about Apple and how their dividend is pretty measly. I mean, right now you're looking at 20.5 cents per quarter. That turns into 82 cents per year per share. Now, if you have thousands of shares of Apple, it's pretty good change. But if you are like most people, and maybe you have just a few shares of Apple, or maybe for this example, because it's options, we'll say you have 100 shares, we're talking about $82 a year from just holding on to those stocks. Now, I know what some people are going to say, like you get the appreciation from Apple and that factors in, but you can make a lot more money through covered calls. So I did some looking around to see what Apple options look like for ones that are going to expire within the next 5 days. For covered calls for stocks you want to hold on to over the long term, it is good to do covered calls for the options that will expire within 5 days or less. So for a strike price that is represents the stock has to gain 20% in the next 5 days to get there, which isn't going to happen unless Apple does an incredible earnings report or some incredible news item comes out about Apple. It's very unlikely for it to go up 20% in 5 days without some type of strong catalyst. And you never really want to do covered calls or cash secured puts during earnings, because that's just a little more unpredictable and you could get a big movement in either direction. But for this 20% growth for strike prices that's that far away, you would get 8 cents per share. And since you have 100 shares, we're talking about $8. Now, this is something that expires in 5 days, and you could keep on doing this. And this is a very conservative number. We'll talk about non-conservative numbers later on, but 8 cents a share, $8 for the week. You do that for a whole month, and you're up to $32 for that month. So in 1 month, you made more from the covered calls, very conservative covered calls, versus what you're going to make from the quarterly dividend payment. So you keep on repeating that process, and then within 3 months, you make more money from the premiums than you would in the entire year of the dividends. One of the things I noticed, because I have spreadsheets where I track all my income and expenses and my investments as well, is that in 1 month of options, I made more in the premiums that I made the entire year in dividends. And I was collecting dividends January up until September, because that's the time frame I was in when I started to do the covered calls and the cash secured puts. And I just did 1 month of that, and it exceeded all the dividend income that I made just because of the premiums. And in all those cases so far, I haven't had to sell any shares. I've been able to buy the shares at the price I wanted to buy them at versus the price that they were at before I did the cash secured put. So this strategy is really great for building up income, and you can do it much faster than dividend investing. Now let's take a slightly less conservative example and say you want to do a strike price expiring in 5 days that is 10% higher than the current strike price. Again, something like Apple, very unlikely to go up 10% in 1 week unless there's a really big catalyst. And you would always do this outside of earnings because, again, you never really know what's going to happen. So at that point, you would get 40 cents per share for, and again, this is just based on what I was looking at right now. If you're watching this video a year from now, the premiums could look completely different. But in any event, it added up to 40 cents per share for this covered call, which means $40 in premium for that week. You multiply that by 4 just to make the math easy, and that turns into $160 each month. And in 1 month, you make almost twice as much as the annual dividend that you are going to get. Now, if you were to go more towards the only 5% higher than the strike price, or even at the strike price, you make even higher premiums. And if you do end up having to sell the shares, you could keep on doing, you could even save money. So if you sell Apple at, let's say, $110, and you set a cash secured put then at $100 a share, and it hits that $100 a share, you save that $10 per share that you would have lost by holding on to the stock. And then that's an extra $1,000 you could do with as you please. So you don't have to do this with dividend stocks. You could do this with almost any stock or almost any ETF, and it's a great way to increase your returns. And if you are a dividend investor looking for income, options beats out the income you would make even from something like an AT&T. So in, again, that conservative example of $160 each month, where each strike price, just based on the premiums that I was looking at for this video, it's $160 each month, and that adds up to close to $2,000, not quite there, like 1,920. That's where we were truly at. But if you look at Apple's share price of the current $106, that is just shy of the equivalent of having a 20% dividend yield. And it does get taxed as a short-term trade, like it gets taxed in that short-term category, but dividends do get taxed as well. And at the end of the day, I would rather get taxed on money rather than having the capital loss and then not having to pay any taxes. Because with the capital loss, it implies that you're in the red, and if you have to pay tax on your capital gains, it implies you were in the green. So I know some people are a little nervous about the taxes. Some people it makes sense because maybe, like, you know, what bracket do you fall in? Does making a little bit of extra money through options push you to a higher bracket? But that's different advice that we're not covering in this video. So it is good to think about covered calls and selling them like 20% higher than what the current stock price is for something like Apple. Like if you're doing AT&T, then you're going to have to set the strike price closer to the actual price, because people know that AT&T barely moves, and they're not going to buy calls for AT&T for like $40 strike prices that expire in a week. Like that doesn't happen with AT&T, but stuff like that does happen for a stock like Apple. So dividend investing, I've been a big fan of it. I even have a video on my other channel detailing the math behind $100,000 per year in dividend investing. But I just think selling options presents a greater income opportunity for people who their primary reason for dividend investing is to someday retire. And you could even use the option premiums to build up the dividend portfolio if you do want to reach a point where you retire just from dividends and you just don't want to go through the process of selling options on your account anymore. So in any event, if you guys enjoy this video, make sure you subscribe, smash the like button, and I'll see you guys next time.